The following is paid programming.
It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hey, everybody, this is the Tax Lady, and this is our hour to make sure that you know about taxes. Even though it's the middle of summer and you're probably at the Allentown Art Festival, and it's a beautiful day, hey, they still want your money, and we want to make you smart. So I'm joined in studio with Christopher Fabian. Hey, Chris.
Hello, Esther.
And Tiffany Fabian.
Hey, happy Saturday.
Happy Saturday to you. And I heard it's a beautiful day. Right?
It's so ideal. It's
Yep.
just a
And
slight
low
wind.
humidity and
Yes.
low temperature, so you can walk around in the sun.
Yep.
And that's cool.
Good day to do yard work. I know that's what Chris was doing. And he had his wife working just a little bit. So we had a good day doing some yard
Well,
work.
that's great. All right. Well, there's all this stuff going on politically, the big beautiful bill, and you hear all of the media slanting the stuff that they want to slant it. And I just thought it would be really good to make people understand how people are really taxed, because I don't think people really have a grip on it. I mean, do you guys?
No, excuse me, that was loud. Maybe last week I heard somebody on Money, somebody first name and then Money, talking about taxes, and she says, yep, all the savings are for the rich in this new big beautiful bill. And then I proceeded to call you and say I don't think she had a good grip on it, and so you are always good at breaking things down. And
Because I want people to understand, it's when you take a look at the way our income is taxed, and some of it isn't taxed at all. It's a graduated income tax, so it starts at 0 and goes up to 37%. So all of your income is taxed at whatever tax bracket you end in after I show you everything is whittled down and everything. So if you are getting a $10,000 deduction and you're in the 10% tax bracket, you're going to only save $1,000.
that's
right?
right. That's right.
But if you get that same $10,000 deduction and you're in the 37% bracket, you save $3,700.
Oh my God! See, there you go. The rich get it. Ha ha ha.
And that's why I wanted to talk about this, because that's where they're getting this, that the deduction is going for the rich, because if you got a deduction and you're in a higher tax bracket, it looks like they're getting all of the gravy. But I wanted to talk all about this. So anyway,
So it's really-
and how about letters? Are we getting special letters right now?
Yeah, there's one of my clients who she still hasn't gotten her New York State refund. She has filed on time, and she still hasn't gotten her refund. And so it was a New York State refund. So we called, and New York State had just mailed out the letter. It took them a long time, and it's that they wanted proof of her
The withholdings.
withholdings, and so they, New York State
So
wants
you had to
proof.
send in the W-2.
Yeah, well, she's not working, so it was all of her pension.
Yeah, but still, we had
1099-R.
it seems a lot of New York State doing their stall tactic. I mean, we had another lady who mailed in all her W-2s like March 26th. We called New York State with her yesterday, and New York State said, "Oh, yep, we're just on the middle of March now. You got to give us another 30 to 60 days."
Yeah.
So they're stalling.
But here's the thing. If you get a letter or you haven't gotten your refund or whatever, EG Tax is here in your corner. Give us a call. We will help you as much as we can. If we actually do work for you, that's the only time we're going to charge you. But we absolutely are happy to help you out. And our phone number is 632-7886 at our corporate office. And our website is egtax.com. But right now, we're at 803-0930. 8030930, star 930 on a cell phone. You can text us at 716-8030930 so as you're probably walking around eating a corn dog down at the Allentown Festival. All right, so how are taxes really taxed, okay? Because this really, it's not what you think it is, I'll tell you. First of all, you put down all your taxable income, but there's a bunch of income that's not taxable, right, that you don't
Yeah.
have to put down. Then you take all of your adjustments. So the adjustments are a subtraction from your income. Then you take your itemized deduction or your standard deduction, whichever is higher,
Right.
right? And that reduces it further. Then you come up with taxable income,
That's right.
right?
Yep.
And that's what your tax bill is based on. But then you're not done, because then you reduce that tax bill by credits. And we're going to talk all about credits and everything. And then what's left is your actual taxes. Now, if you're self-employed, you're going to have an additional FICA if you have a net profit. And if you didn't take money out of your pension plan like you were supposed to timely, there'd be another credit. But basically, once you apply your credits, if you don't have any other taxes due, that would be your actual tax liability, right?
Right. And that's where people can manipulate the tax law too, where they say people don't pay taxes. Well, they got the credits. Well, those credits are there for everybody: the electric vehicle credit, the energy credit, the foreign tax credit. You know, all those credits are there to help lower your taxes. And so you know, if someone's looking, like you said, well, here's the tax after my income, and they're comparing it to somebody else after credits, that's apples to oranges.
So here's an example, and I know we're coming on break. Let's say a taxpayer with 2 children under the age of 17 has wages of $40,000. And so their gross income is $40,000. Their standard deduction is around $30,000. It's $29,200. So their taxable income is $10,000 multiplied by their tax bracket, which is 10%. So their tax bill is $1,000, right? But they have children under the age of 17, so they qualify for the child tax credit, and that's going to save them $2,000 times 2 kids, or $4,000. So now they don't pay taxes. In fact, what happens is the federal government owes them.
That's right.
They didn't have anything withheld, but because they had that refundable child tax credit, they're actually going to get a refund of $3,000. Oh, but they have wages and they have qualifying individuals, so they also qualify for another credit called the Earned Income Credit, right? So they're going to get an additional $4,773 from Earned Income Credit. So now their actual refund they're going to get, and they didn't pay anything in, is $7,773. And then they go to New York State, and New York State gives them money back too.
Yep.
So when they're all done, they're going to have refunds on their $40,000 of about $10,000. And hallelujah, you know, we love helping people like this, but people don't know that in fact our tax system many times is a welfare system, and it provides income for lower income people.
Yeah, I always tell people there's lots of social programs built into our tax code. One of my clients texted me last night, and she said that her fiance can't claim any of the kids, but the mom who gets to claim the kids didn't work at all. And so she said there wouldn't be any benefit for her claiming the kids, right? And I said, that's right. And then she proceeded to text later. She goes, oh, you know what? I forgot she worked a little bit, like 4 months. I go, oh, well, she probably got a great refund, you know?
Well, it depends on how much she made. If she made $1,000 working part-time, it's not going to be much of a refund. And in that situation, when people that are listening in that situation, if you can get somebody to mediate, a lot like between Iraq and Israel right now, you know, if you can get somebody to mediate and you say, look, if I claim the kids, I'm going to get $4,000, and maybe let's say $4,000 because they're under the age of 17. And if you claim the kids, you're only going to get $1,000. I will split the refund with you 2 and 2, and I will put on the tax return that refund, part of the refund goes directly to you, so you have nothing to worry about.
Right, a Form 880.
And she'd have to just sign a form over that says that she allows him to claim the children if it's a non-custodial parent.
Correct.
Yep.
Right? Okay, let's go to well, actually, let's take a break. I know we have somebody waiting to
Randy.
talk to us. Again, 8030930, 8030930, star 930 on a cell phone. Text us, 716-8030930. We're going to take a short break. We'll be back with your calls on the other side. Hey, to us, you are family, and I know the family's out in the sunshine today, so that's great. I'm Esther Gillies, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. I got Tiffany Fabian and Christopher Fabian in studio with me. We want to help you, and we have Randy who's been holding. How can we help you, Randy?
Hi, I hope you can answer this. It's a topic of discussion among some of my friends.
Oh, I love topics of discussion.
We all do a little online gambling with, the various companies that offer it. Okay. Now, my question is, let's say they have an end of year statement, and let's say they say, I want $1,000 in bets, but I gave them over the course of the year $1,500 in money to bet with. In my view, I lost $500.
Right.
Okay.
Mm-hmm.
Does the government, would they look at that statement and say, "Oh, you made $1,000, buddy. You got to pay taxes on it"? Even though I never collected a dime of it.
All right. Well, I'm going to have you started it, Chris. Explain. Make
Well,
the poor man sad.
Unfortunately, that's just like hitting that slot machine for $1,000 and you feed the machine all of it back. You still have to report the $1,000 win on your tax return. Your losses you would be able to use as part of your itemized deductions if you can itemize up to your gambling winnings. So you wouldn't be able to use the whole $1,500, but you would be able to use $1,000 to offset the winnings.
So,
but I'm going to tell you, Randy,
and
again, it's like doublespeak when you're talking about taxes, because Chris is absolutely correct. The income goes on the income section. Then did you hear him say, if you can itemize,
So it would not
then
be a
you can
wash.
then you could take the $1,000. But if you can't itemize, because are you a single or married gentleman?
married.
So and are you
filed
under
joint.
65?
No, over.
Okay, so your standard deduction's like $33,000. So if you can't come up to $33,000 in itemized deductions, then you never get to use the $1,000 as an expense.
So to answer your question, it is not a wash.
Right. And then, Randy, I don't want to even put more salt in the
Social
wound.
Security,
Sorry.
your Social
I
Security.
don't like it so far.
Yeah, it's going to, depending on your other income, it could make more of your Social Security taxable too. So you're not only going to pay tax on that $1,000, you're going to pay tax potentially on another $1,000 of your Social Security.
And if you're a high roller and make a lot of money gambling, the IRMA, which is your Medicare, you can get hit with IRMA and you have to pay more on your Medicare out of your Social Security every year.
So how's that for good news, Randy?
That's not one answer I like.
That's
But,
why, when
Under
you
600, do I have? Like, let's say I made $600 for the or $500 for the year.
Mm-hmm.
Still declare it legally. I should, right?
right.
The old
But
under
here's the
600.
thing.
They don't.
But here's
care.
the thing, Randy. Depending upon your tax, so let's really give you real numbers. If you and your wife have maybe you don't have a large pension plan, maybe you and your wife, after your standard deduction, don't have to pay taxes. So when you put that $500 in there, you're in the below 10% tax bracket, or 0. You don't have to pay taxes. But maybe you're in the 10%
It would be a minimal
bracket.
effect then.
Okay, so $50 if you're in the 10% tax bracket.
Okay. Well,
so it's
when
nothing.
I hit it big, I'll call you back.
All right. All right. Thank you, Randy.
Well, have a happy Father's Day, Randy.
yes,
Thank
happy
you very
Father's
much.
Day.
Same to you.
Thank you.
Bye-bye.
Yeah. Yeah, that's true. Happy Father's Day to all the fathers. 8030930, 8030930, star 930 on a cell phone. Text us at 716-8030930. The other thing that people have to be cautious of this year is the 1099K plan form is going to definitely be sent out to people this year that are doing third-party pay. Like we've talked about this before, about the Venmos and whatever third-party payer, and you're selling tickets and people are paying you through Venmo, they're going to send you a 1099K for that this year.
Right, right. And we've seen people who have Sabres tickets, Bills tickets. You know, they sell their seats and they're like, wait, why did I get this? And we're like,
For
well,
the Sabres, though, don't you have to pay somebody to take the tickets?
some games.
I know, not for the Bandits. The Bandits were wonderful, and the
Yes.
Bills are wonderful.
Yes.
But Sabres got a tough time. All right. So here I would really like you guys to understand how you're being taxed. And so not all the income that you're putting on your tax return is taxed like you think it is. For instance, wages are fully taxed, but you also have to pay FICA on the wages. The FICA is 15.3%, but your employer pays half of it and you pay half of it. So if you made $10,000, you're going to pay $785 in FICA, and can you deduct that anywhere?
No.
No. And when you take it out, it can be fully taxable if your income is over the income limits, right? Because that's
Yep.
what we've been talking about. So wages are fully taxable. Interest is fully taxable. But let's say you're an investor and you are getting dividends and they are qualified dividends, then you're getting a tax break for that, right?
Correct. You can pay 0, 15, or 20.
And the maximum you can pay is the 20,
Correct.
right? Except for the Medicare tax, right?
Yes.
So if you have dividends and capital gains, then you're going to pay less than you would have paid if it was wages or interest.
That's right.
Right?
That's right. Yep. Because you're going to be taxed at your capital gains rate instead of the regular tax rate.
Now, if you have rental property, that's taxed differently too. So if you have rental property and you're renting it at fair market value, is that important?
Yeah, the law says in order to take any losses that you might have in the rental, you have to rent it out at fair market rent. And so you can't be renting to families at a reduced rate or to other
your friend.
siblings or your friends. Yeah, and then something else I want to mention, somebody I saw in the office this week, she's married and she owed a lot of money and she just wanted me to review her return, which is really smart. And she's like, we had this huge rental loss. And here we go with married people. I mean, married people who make around 230 is maybe pretty going rate nowadays. And they were disallowed any of their rental losses. They were suspended. And so, you
And that was exactly where I was going, because rental property, you take the gross income, you put it on a Schedule E, and then, and again, it has to be at fair market value. Then all the expenses to operate the property plus depreciation reduce the income that you got, and then you only pay taxes on the bottom line. But if the bottom line is a loss because of the depreciation, right? Mm-hmm. And your income exceeds $100,000, you start to phase out the amount you can take as a deduction. And once you're at $150,000, you can't take any of those losses. Like Tiffany says, they're suspended until you sell the property.
Yeah, or if your income drops. Yep,
Right.
that's right.
So it can be really frustrating. So some people have said to me, well, then why would I buy rental property? Well, you buy it because it's an investment.
That's right.
I mean, the whole thing, in order to take the loss, you have to be wanting to make money. You have to have a business motivation. And if you have a business motivation and you have a profit at the bottom line of the Schedule E, what else can you take as a deduction?
You could at the bit
A QBI.
QBI. That's where I was going. Bottom of the 1040. Yeah.
You'd be able to take 20% of that bottom line
Yeah.
as an adjustment to income.
Yep.
If you're operating as a business. And again, if you have business property, that's why you should be doing that. So, all right. Then the other thing that's taxed differently is self-employment income, right?
Right?
So and here's the rub. It can be a sole proprietor. It can be a limited liability company. It can be a subchapter S corporation, or it can be a full corporation, depending upon what structure you have put or started your business in. And each of those different structures can all be taxed differently as well.
Correct. I
Right.
mean, yeah, there could be, just basic income tax, and then there could be self-employment tax as well as the income tax. And so you got to really be careful and know what you're doing when you set something up.
Right, and now the limited liability companies are really a very smart thing to do, because it mitigates the amount of money in a lawsuit that you as the owner could be assessed. They could only go after the asset as opposed to your entire net worth. So that's something that if somebody has self-employment or even rental property, right? Think about turning it into an LLC,
Yep. Yeah.
right?
Yes.
Okay, and then
We got to take break for the news.
I know.
That's a
We're-
hard
and,
break.
but- and I can say this though, and pension income is fully taxable. And we'll talk about this on the other side. I'm Esther Golias, the tax lady. Hey everybody, this is the tax lady. Want to wish all the dads out there happy Father's Day. Dads have such an important role to play in the life of their kids, and want to wish everybody a happy Father's Day. But I'm from EG Tax. I want to help you with your taxes. I'm Esther Golias, the tax lady. 8030930, 8030930, star 930 on a cell phone. You can text us at 716-8030930. I have Tiffany Fabian and Christopher Fabian here in studio with me. We were talking about being self-employed and the different way things are taxed. On your bottom line, if you're self-employed, you're going to pay 15.3% in FICA. You can't get away from that.
Right.
And you don't have anybody helping you because you have to pay the whole freight. And if you're an employee, your employer pays half. But if you're self-employed, you have to pay the whole 15.3%.
That's right. Yep. Something to consider, and you really have to
And you have
budget
to plan
and
for it, because that can really add up.
It
Really
can.
can. Right. I mean, on $20,000, it's over $3,000 that you'd owe in FICA just right then and there. I'm mentioning before the news break that pensions are taxed just like wages, ordinary income, but not on New York State. Right?
Right. Yep.
So depending upon the type of pension you have, it's taxed differently. You want to explain, Chris?
Sure. So if you have a government pension, meaning from the city, state, county, or federal government, post office, railroad, you're on New York State, your pension is totally tax-free. But if you have your 401k, your IRA, the first $20,000, once you hit 59.5, are tax-free every year.
And just on New York State. We're
Just on
talking
New York.
strictly New York.
Correct.
Right.
Correct.
And that's a big deal, because I will tell you, if you're over the age of 59 and a half and you have a pension and it's a and it's a governmental pension, and you have not been subtracting it, you have money coming back, and you should amend your return. Because to my knowledge, I don't think the state points it out to you.
Correct. Yeah,
Right?
they won't write to you and say, "Oh, you made a mistake. We owe you money." No, they'll only write to you to say, "You made a
You owe us
mistake.
money."
You
Right.
owe us money plus
All right,
penalty and
then-
interest."
All right, so pensions are a big thing, especially in New York State. Social Security is completely tax free if your income, including half the Social Security, is under 25,000 and you're single, or 32,000 and you're filing a joint return. That hasn't changed in like 18 or 19 years. That's been the same floors that have been there. Had they increased it for inflation, it wouldn't be taxable till your income was over like $100,000. But that's not the case. And you can pay up to 85% on your Social Security. And so that's why, remember, our caller was talking about gambling. Gambling can absolutely shoot you in the foot for your Social Security, or like Tiff was saying, the IRMA.
Right, and it's you don't pay an 85% tax, 85%, because I can feel
of
some
the
people
Social
out there going, "Oh my God!"
Yeah, that's right. right. And we were hoping with the big beautiful bill, because that's how it was touted, that they were going to get rid of Social Security. And I said we'd be dancing in the streets. Well, we ain't going to be dancing in the streets. So they're only going to make the seniors get an extra $4,000. But I think it's $4,000 for husband and $4,000 for wife, which would be $8,000. Which would be pretty cool. But of course, as soon as this thing unravels, and they say by the 4th of July, so it's coming up, we're going to make sure everybody knows that. So, all right, so there's that. So the other tax.
Should we go to Mark?
Yeah, we'll go to Mark. Thank you, Chris. Hi, Mark. How can we help you?
Hi, happy Father's Day to all the fathers out there, number one. And number two, Esther, I want to ask you a question. I just settled a family estate, and I was wondering, there was a piece of property involved, and I was wondering, I want to close the estate out now, and do I pay the taxes on the estate, or do the individuals, and how do they figure out the taxes on the estate gain?
Who sold the property? Did the estate sell the property, or did the heirs sell the property?
I am the executor of the estate. I sold the property.
Okay.
But
Chris,
whose name was on the closing statement? Was the estate of, or was it your name? It was the estate of.
And that's how the TIN checking account is written. The estate of.
Okay, so the sale of the property, the nice thing is because the estate inherited the property, so they would get the stepped up cost basis. So the odds are you're probably not going to pay tax on that unless you used it as a rental property for a while or the estate dragged out for 10 years. Unfortunately, we do see that.
The estate dragged out for 11 years.
Oh, gosh, so there could be tax on that
All
property.
right, so you're saying that you inherited the property and then it was in the estate, and the estate rented it out for 11 years?
No, they just held on to it, I think.
The three children inherited the estate. I, as the executor, held on to the estate for them. One of them lived in the house. Nobody collected any income. It was never rented or anything like that. And as they were ready, I sold it as the estate.
All right, so you're going to get a stepped-up basis based upon what it was worth on the date of the death of the your relative that left it to you. So all of this appreciation that went on these last few years, and the house is worth so much more than it was when you inherited it, all you're going to be able to do is get the fair market value and the date of the inheritance, plus any improvements that you made, plus any expensive sale. You'll come up with an adjusted basis, and you take that and subtract it from the sale price, and that's what's going to be taxable on the estate return.
And the state has to pay that tax, not the individuals. Right?
Correct.
Right.
Okay, so I asked the lawyer about that, and he said there was no tax on it, but I didn't think he was right.
Well, but not if you held, if you had inherited it in January and sold it now, there'd be probably no increase in fair market value. But back 11 years ago, I mean, the real estate market went crazy here in Western New York.
It went up about $100,000.
Well, that's wonderful. But again, the most you can pay is 20%. So if your gain, after all your expenses and everything, let's say your gain is 50,000, so you'd have to pay $10,000 in taxes, plus in the state of New York. That's just to give you a thumbnail sketch.
Oh, so there is a big tax on.
Yeah, I mean, if you want to call us during the week, we can run the numbers and give you a better idea what it's going to cost.
And all your improvements over the year, that all gets added to the adjusted basis when you inherited the property.
Yeah.
And the expensive sale.
Yeah, because the real estate, like Esther said, the real estate, the lawyer fees, the taxes on the property,
When they had to go
deed.
down to Erie County
Yeah.
and pay off whatever they do down at Erie County.
All those
I mean,
fees.
all of those things are going to increase the cost basis. And from that, you take whatever you sold it for.
I see. So if they consider that a $100,000 gain,
You'd pay.
you'd only pay 20% of that minus
Right.
whatever your costs were.
Right.
Okay. All right. Thank you very much.
Well,
I'm
give
gonna
us a
call
call.
you
We'll
out.
help you. We'll help you work it out, so you don't have to do it at tax time. Because this way, we'll help you to get. You want to get your ducks in a row so that you know exactly how much you're going to have to pay at tax time.
Yeah, because they're waiting for their money now, and I can't disperse it all
Right.
until I know
Right.
what the costs
Right.
are.
Absolutely.
And I
All
didn't
right.
think it was going to be as high as 20,000. This is something that should come into the office, right?
I think it would be a good idea.
All right. Do I have
right.
to make an appointment, or can you
Yeah.
come down?
That would
yeah,
be
just
recommended.
call the
yes.
office on Monday morning, and we'll take care of
The
you.
phone number is 632-7886.
632-7886.
You
Okay,
got
Mark?
it.
Thank you.
Thanks, Mark.
Happy Father's Day.
Yep. So
All right, and then we have a text, right, Tiff?
There's a few text, and then there's one more phone call. The next text, it says, Esther and gang, to simplify taxes, will they ever switch to a flat tax? And so you want to hear my 2 cents
Oh,
is
I want to hear your 2 cents.
my 2 cents is there's so many social programs built into the tax code, like the earned income credit, the additional child tax credit, the child independent care credit, the college credit, AOTC, EIC, the energy credit, adoption credit. There's so many social programs which are beautiful and wonderful. And so and things that motivate people to work, I can't see them getting rid of it because of that.
You want to know why it could never work? Because everything is based upon, if they had a flat tax, let's say somebody has $4 million in gross income.
Right.
If there was a flat tax, let's say 10%, just to keep it simple, that guy would pay $400,000 in taxes. Okay.
Yeah.
If somebody made $100,000, they'd pay $10,000 in taxes. But right now, that person making $4 million would pay $945,000 in taxes. So that person would get like a 50% tax cut.
Ew.
And you think they're saying now that the rich are making out? The rich would be dancing in the street.
Wow. Wow.
Because the rich people are paying 37%. So
Yeah.
if flat tax would benefit wealthy people for sure. 10% on somebody making $100,000, paying $10,000 in taxes is a lot more punitive than what they would have paid, because they would have paid more like $5,000. You know.
right.
Good point.
All right. Then we have a phone call.
Me-
How are you,
Michelle.
Michelle? My bell. Can I help you?
Hi, Esther. I enjoy your show. I listen to it every Saturday.
Thank you.
All right, I have a question. I just got my first Social Security check. So I'm
Yay.
60. Yay. So I got my check, and then Social Security sent me a letter saying potential private retirement benefit information. I used to work for a credit union, and so this is the type of benefit. It's a single lump sum. Now, is it too early for me to cash in that money because I'm only 62?
No, once you're 59 and a half, you're free to do that if you want to. However, it's going to be fully taxable when you take it out. So there won't be any penalty, but it'll be fully taxable. How much is in there, Michelle?
About 56,000.
Okay, so you got to figure for sure it'll make your Social Security 85% taxable. So what I would do is give us a call. We'll work out the numbers, and then it's a numbers game. It's up to you.
And you might want to spread it out over 2 years. Take
Right.
out part in 3 years. Take out part in 25, part in 26.
Right, because you certainly don't want to have to pay taxes on your Social Security if you can
No,
avoid
I
it.
don't. No, I don't. I work part time still. I'm making under the limit, and I'm having them take 10% out for taxes.
Right.
For if you think
But
that's
the
a
thing
good-
is that 58,000 is going to get added as ordinary income to
Income.
all your other, and for sure are you single or married?
married.
And
Yeah,
you only
well-
get to exclude 20,000 on the state.
Right,
So you
and it could make the Social Security tax up to 85% taxable for you and your husband.
you're far better to keep
So
it under
you'd-
20.
Let us work it out for you. That's what I'd suggest.
All right. Well, I appreciate that. I'll give your office a call.
Yeah, because you can call us and we'll just do it over the phone.
Oh, thank you. Thanks,
All
Esther,
right.
and everybody.
All right.
You're
have a nice-
welcome.
Happy Father's Day to your
Congratulations on your retirement.
Yes.
Thank you.
Partial.
Thank you. Yes. Thank you so much.
Enjoy the weather. Okay, I'm Esther Golias, the tax lady from EG Tax. We're going to take a short break. We'll be back on the other side. Hey, to us, you are family. I'm Esther Golias, the tax lady, with Christopher Fabian, Tiffany Fabian. We're talking taxes, and we want to make sure, even though it's a lovely day and it's the middle of June, that you think, I don't want to talk taxes now. But I want to tell you, what we say today can really help you out when it's not so beautiful outside. Right, guys?
That's true.
All right, we have a couple texts.
Yeah, the first one says, "Hello, I want to clarify something regarding New York State and IRA distributions. Is it just the amount that's over 20,000 that is not taxable on New York State, and the whole distribution on the federal?"
Well, it all depends, because what's a subtraction on New York State, if it's a governmental pension, is up to the first 20,000 that you receive in pensions, annuities, and IRAs for yourself and your spouse. So let's say you had a New York State pension of 75,000. That whole thing is tax-free on the state of New York. All right, you back it off. And then let's say that you had $40,000 in an IRA distribution. Then the first 20,000 would be a subtraction on New York State. And let's say your wife has 15,000 in an IRA distribution, you could take up to 20,000 or 15 for her, okay? But you have to add all of those qualifying pensions together that are non-governmental, and you apply the first 20,000 to each one if you're filing a joint return.
That's
Okay.
So yes, if it's not a government or municipality, city, or government entity, it's just 20,000 if you're over the age of 59
But
and a
you
half.
still carry forward that whole figure from the federal to New York State, and you subtract it. It's a subtraction to income. You have to make sure you don't just leave it off. You have to subtract it out,
That's right.
because the income has to equal what's on the federal.
Yep, it's a little
On
bit
page
of a.
one.
Yep.
Okay, we're good?
Yep, we're good. And
Okay.
then there's a text and a phone call. What should I do first?
Well, let's do the phone call.
Okay. Hi, no name. How can we help you?
Hey, I just wanted to know, is there a way to sort of offset different tax gains by making a charitable donation? And I was thinking of, like, what was in the news recently. Could you, like, give, say, to your parish for a whole year all at once as a charitable donation and designate that you want the funds to be used in a certain way?
Absolutely. So that's called a charitable, basically it's called a qualified charitable deduction, okay, QBI.
And that would only be if you're over 70 and a half.
And you have RMDs, and it's got to be an IRA. So up to 110,000 now you could do as a direct rollover from your IRA to the charity of choice, and that would make you fulfill your RMD requirement, and it would make it up to tax-free. It wouldn't be taxable at all.
Okay, excellent. Thanks for the information.
You're very welcome. And that's how I make my contributions. I make them in one lump sum every year, and I got to do my RMD, and that's what I do. So great call. Really appreciate that.
Okay, thanks.
All right, we have another text.
Yeah, it says, "Oh my God, Esther, you were going to be dancing in the street if they got rid of Social Security? Question mark, exclamation point,
I
etc."
would dance in the street. I mean, it's really a shame because, in my mind, Social Security. So many seniors are paying taxes on Social Security now, and it's really terrible because they're basically paying taxes and they shouldn't be.
Right. Yeah, I think we could throw a party, and you would be joined by.
I would be dancing on the table, that's for sure.
Yeah.
So
sad.
it's a good time to talk to Schumer. It'd be nice if they got in on the big, beautiful bill and got that in there, you know?
Yep.
So anyway, going back, we're good with the text and everything right
Yep,
now.
clear.
Wanted to make sure that people understand that there are other sources of income that we don't pay taxes on. You don't pay taxes on food stamps, welfare, scholarships, as long as it's a degree program, employer provided health insurance. That's a big one, right? Alimony, if it's a post 2019, right?
2019.
2019 divorce, workers' compensation, VA benefits, those are all fully tax-free. So if you get those, if you're putting those on your tax return, you got to amend the return. Speaking of which, Tiff, we were talking about this a couple days ago, the 229. Tell people about that.
Yeah, so for the not tax year 2024, but for 23, 22, and 21, New York State only had a credit on your return, the IT 229. So if you weren't like a huge high income earner, but you were paying property taxes, you would get a credit on the return, a refundable credit. Doesn't matter if you paid taxes, doesn't matter if you had to pay taxes. It was up to $300 and
$350.
$250 to $350.
and so that was money in your hands. And so if you didn't claim it,
who should this pertain to?
Well, it would be anybody who pays property taxes. They should take a look at it, because if you pay more than 6% of your income for your property taxes, then you could qualify for this credit. And you got to try it. If you didn't try it, please try it, because you don't want to.
And this is New York State only.
yeah, and there's so many seniors who don't even have to file, and so it doesn't even, not even a thought that enters their mind. And so it's people who even don't file who could potentially be eligible to this credit. And it's for 2 years, and it's going away soon. And so I just want people to take advantage of it. And there's one more call. There's Marlene, who just called in from Lancaster.
Hey, Marlene, how can we help you?
I was wondering, if this bill goes through, will it be retroactive to January 1st of 2025, do you think?
Oh, well, it's really interesting, because yesterday they were saying that that's exactly what the Senate wants to do. They want to make it a retroactive benefit.
'cause
But
sometimes they say-
until these people vote on it, it isn't in law. And then any changes they make, you got to go back to the House again.
Yeah.
But yesterday I read that the Senate wants to make it retroactive,
Yeah.
because then
The
it would
other
give
thing
everybody a shot in the arm.
One day I was listening to the radio, and an insulation place was talking about having insulation put in your house, and you end up saving 80%. Is that possible?
Okay, see, and I didn't get to it, and maybe I'll do this next week. There are credits that are non-refundable, and there are credits that are refundable. An
Yeah,
insulation credit is a
insulation.
non-refundable credit. So
Yeah,
if
it
you
comes
don't
off of
have to
your-
pay taxes, you're
Yeah,
not going
you're-
to get any benefit for it.
Yeah. Okay, well, 80%, that sounds almost ridiculous.
Yeah, because I don't think it was correct.
Well, it isn't quite that much. Well, it could be 80% if
Yeah,
you didn't put
insulation
much
was
in.
up to like a $1,500
Yeah,
credit.
right.
So
But again, it's a
30%
non-refundable
up to-
credit, and so many times salespeople tell you that you're going to save $1,500 in taxes, but if you don't pay taxes, then you don't save anything. And that's the mystery of the tax code, and that's why it's so misleading when you hear politicians talking about how all of these benefits are going to happen to all these rich people. Well, the truth of the matter is, once you get to 400,000, you don't get any benefit of this stuff at all. So you just you gotta be careful. And unfortunately, if your income is lower and you could have qualified for a credit, if it's a non-refundable credit, you'll get no benefit then either.
Yeah, right. You got to have enough tax to
Right.
have something
You're
to take off.
absolutely right. Smart
Okay.
lady.
Thank you very
Thanks
much.
for calling.
Thanks, Marlene.
Bye-bye.
All right. All right. So, wanted to point out that, let's say, a family of four with kids under the age of 17, I talked about that first, but their income's $75,000. After their standard deduction, they'd have taxable income of $45,000. So their tax bill is $49.36, but they get a child tax credit of $4,000, so that drops their tax liability to only $936. So, and if they were like Marlene and they had done energy conservation, well, then they could have reduced their possible liability by an energy credit. So they might pay no taxes at all. So that's where, and so then they pass these tax changes, and you find out that the lower income people may not benefit because they aren't paying taxes at all.
Right. Right. And to me, that's a great big tax cut right there,
Right, when you don't pay
And they're the ones
taxes
that
at all.
complain that the rich don't pay any taxes.
Right, and so that's the other thing. When you're somebody working on tips and you don't have to pay taxes anymore, you might not have had to pay taxes in the first place. But then there's some people that it will benefit. So if once we get this thing sorted out and we hear what they're going to do, believe me, we will keep everybody abreast of everything. Another thing that they're proposing is this Trump savings account. All kids under the age of 4, they're going to give $1,000 to set up a savings account that would continue to grow. You could add to it, and then when they're 18, they could start to take it out for college or purchase a home or start a business. So that's another thing. The whole thing is, I'm on it.
You certainly are.
I am on it. I love reading this stuff. And my girlfriend's reading a novel, and I said, I love reading tax code.
You certainly
She said,
do.
you are sick. But anyway, I'm Esther Goulias, the tax lady from EG Tax. If you need help, go to our website at egtax.com. You can call us at 632-7886. Until next week, I thank Christopher Fabian, Tiffany Fabian, and all of you dads out there. Have a wonderful time. Enjoy the great weather. Talk to you next week. God bless. Bye-bye.